Most Canadians do not have a retirement plan. They have a house and they have hope. But let me be absolutely blunt here. That's not a plan, that is a gamble. And the odds are getting worse and worse and worse for the average Canadian who's banking on their home to be their retirement strategy into the future. Over the next 18 months, we've got 60% of mortgages coming up for renewal, and most households will see payments rise 10 to 20%, even with the rate cuts that we've seen in the last year. At the same time, CMHC expects national house prices to fall around 2% in 2025 overall. And we've already seen the big majority of the drop. With like bigger drops here in Ontario and BC, which is where people really bank on the equity growth, it means the idea of your future retirement plan that some people aren't thinking about today, but most people are considering, it's about to cost more money and be worth less at the exact same time. This really matters because Canadians more than ever are depending on their home to fund retirement. And if you're in your 30s, you might not be thinking that way yet, but the way our society works, economically speaking, that is what exactly is going to happen. And that's what Canadians have been trained to do. So today, I'm going to break down why, basically, when it's smart and when it's dumb, and the exact guardrails you need to consider how to use real estate in the future. And let's be honest here. I am a real estate opportunist, but I'm not here to pump real estate. If it doesn't make sense, I'm going to straight up tell you. And if it does, I'm also going to tell you. And that's the goal of realistically this entire freaking podcast and YouTube video here. Let's get into it though. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadden, and I'm your host. I can't wait to get you into the flow. There is an article I saw published just a week ago about how Canadians are relying so heavily on their real estate for retirement. And this last year has basically seen a backfire in what happens. Nationally speaking, to give you some stats, 62% of Canadians say their home is their retirement strategy, with 44% of them planning to sell basically to get the money to retire and live on. 33% of Canadians are planning to remortgage, basically pull equity to their home to survive and live. And 65% worry that they won't be mortgage free by retirement. I'm seeing this honestly every single day right now. Another crazy stat. I know we're stat heavy in the beginning. We'll get away from this. 78% of those with higher payments are saving less money. This is from a CMT reporting from Hoop survey. And it matters because Canadians are treating their home basically like their pension plan, their bank account, and their entire future. That's not even optional for most people anymore. And it's a default plan for millions of Canadians right now. Boomers, yes, but the Gen X and millennials, absolutely same issue that we're seeing. In the actual article, they talked about a couple in Toronto in their late 50s who bought a home in their 90s, typical story, with their home worth 1.5 million, bought it in the low hundred thousands. But with very little money in RSPs, the retirement plan having no real portfolio, it was basically, we'll sell the house, but their mortgage renewal is coming up and their payments were about to jump by 18%. Plus, if you sell a house in a market like this right now, the house isn't selling quick and the market's under pressure. And if you hold, they're carrying, in this case, if they hold, they're carrying on more debt into the retirement. Either way, the house isn't a nest egg, and people are just starting to pick up on that. It is the retirement plan itself. Like, this is literally the plan that people are moving forward with every single day, and they're starting to get shocked by the marketplace. And this really matters right now. Like, it really matters because the BOC itself said that 60% of Canadian mortgages are renewing in 26. I already mentioned that. 5-year fixed borrowers are seeing rates go up, their payments go up 15 to 20%. You went from a 1.89, 1.9% rate to a 4.5 or whatever the rate is. That's an entire nation of shock. And this is going to impact every single person that is in this nest egg strategy that we're talking about right now. CMHC's outlook says the 2% national decline in payments in 2025 in Ontario and BC. Now, part of that's interesting because regionally speaking, some areas are actually up. But if you look at the major cities that have seen equity growth, like in Toronto and in Vancouver, that's where we're at risk. And that's where a significant amount of equity is held. And that's where I believe that most people who are in this mindset are. On top of that, OSFI said 3/4 of people renewing are in 2026 are essentially like a system risk. They're literally worried about household stability. As an aside, I was talking to one of my American counterparts the other day about how these fixed rate mortgages, and he was like, that's insane. You have 60%, so 6 out of 10 Canadians are literally seeing their mortgage rates reset. He couldn't wrap his head around that. And Austria agrees. They're worried about household stability. I mean, Ontario's delinquency rate jumped up year over year, 71%, which is still low, honestly, by all things considered, but the direction is not good. Your retirement plan, I mean, if you're in your 30s and your 40s, you might not even be thinking about this yet, which is kind of crazy, but your retirement plan is your house. And that's what most Canadians are thinking about right now. And your house as a retirement plan is being squeezed basically from both ends, and the equity is being pushed in. You've got less equity upside, and you have a higher burn rate, not only from the rates but also from inflation. But it's not all lost. There are some tools. You're in this position right now, so here's what I'd suggest that people like. Basically, the tools are here's what your tools are if your house is your retirement plan, and that is the way that you've considered it. Number one, we know this: downsizing or selling. Retirees right now have been traditionally over the last 5 years liquidating their assets because it's the cleanest and clearest way to get the equity out of the property, historically speaking. Although many of them would argue differently this year with the fact that property values have declined and it's been harder to sell real estate. But it is a smart move when you sell early. And if you can right size, which is to buy a home that's better for your suitability, before the pressure of the market hits. You create liquidity in your personal financial situation and you can lower your costs going into retirement. But I would say this is a kind of a dumb move. Dumb, I'll call it that. Not a good move when you're waiting for prices to recover and you get forced to sell under renewal stress. And that therein lies the problem with this renewal crisis, that people are doing it for, in many cases, this specific reason during this renewal crisis where values are dipping because people are selling because they're overstretched. The second option, and this is something that I'm talking to people more about right now, which is the possibility of refinancing and holding on to this piece of real estate. So you can, as a retiree or a future retiree or someone coming up to this place, you can refinance your property and pull out equity if you qualify through a conventional loan, through an alternative loan, through a reverse mortgage. And you could spread those payments to extend the affordability of staying in the home you're in or that they're in. And, realistically, most of these properties will regain their value and equity. And it could be a better play to do this and live in this type of home than sell it when everybody else is trying to sell it. It makes sense when it's a small amount of money and it's very specific and targeted and it's converted into an amortizing account. But again, it's not the best idea for a lot of people where it's like, I'm treating this like a pension, because that's when your balances of your mortgage continues to linger on until you die or you have to liquidate and sell the property because you have no choice. There's a reason that all of these regulators have capped the home equity line of credit at 65%. And there is a reason that reverse mortgages only go up to 40 to 50%, because they don't want people to be in a reverse equity position and be unable to make these payments. Which leads me to my next comment around HELOCs and when it makes sense. I mean, there's retirees using a HELOC when it makes sense because it feels like an income source that you could access at any time and pay just purely interest on it. I would say, again, this makes sense for people if it's just like purely using it from a targeted perspective and you're converting it into maybe an amortizing mortgage, because you can do this with different types of loans. But it's a really bad idea, again, if you're using it purely as a pension. The other thing that we're seeing retirees doing more than ever, and we've seen the rush, and a lot of people, like if this is you or if this is your family is trying to help you and you're in this position, reverse mortgages are hotter than ever. We got 3 lenders in the country that are doing reverse mortgages, and they're really actually a good option for certain people. Like, it does make sense. There's no payments. You can stay in the home. And if this doesn't make any sense to move, you can still live there, which, I mean, renting is more expensive than like owning a home in many circumstances, right? You can if like strategically speaking, it makes sense for people who are doing this properly. They're drawing it in stages. They're not taking all the money up front and then they're converting it into either an interest only payment or no payment, but they're making sure that they have it lined up in a way that they're not taking all the equity of their home and being in like a prison, which is something we've seen before, where people take up a giant lump sum and then they have no money or equity left in the property. I think reverse mortgages really get a bad rap around them. But for a lot of Canadians who are thinking about retirement or in retirement stage, if this is your family or your parents, it does make sense. Now, again, thinking about the concept of retirement as or your real estate as a retirement might not be the position that you're in if you're watching this video. But I'm going to tell you right now, even if you don't think this is the case, this is going to be the reality if you are a homeowner in the future, if you don't plan out some type of retirement strategy. And I'm going to be honest with you, most Canadians still at this point, they don't have more than $100,000 in RSPs when they're in their 50s. So this is like real information that you need to be considering to put yourself in a better financial status. Otherwise, we're going to be in a crisis in the next 20 years with most people being unable to retire and working until they freaking die, which might not be bad if you're an entrepreneur or you're self-employed by it like me. But I mean, I hope by that point I'm working because I want to work and not because I have to, because I'm going to make money. I have to make that money. Now, here's some of the guardrails that you can use. I kind of created like a little bit of a checklist. So if this is you and you're younger trying to figure this out, or if you're someone in that retirement stage, number one, I would say cash flow beats net worth. If you can't handle a renewal payment, this applies to everybody. If you can't handle renewal payment at rates of +1 or +2%, don't bet on retirement on growth alone. Number two is you need to cap your leverage of the equity of your property that you're using. If you're using this because of retirement purposes or something like that, you should make sure to keep up, like 60% of your property value, maybe 65% maximum, to preserve some of the equity in your home, and make sure that you're in a position that you could sell and downsize if you wanted to do so. The third thing, this is going to shock a lot of people when I say this: amortize the heck out of everything. It's a tool. Use it. You have to pay interest, yes, but it's not a bad thing. Interest-only HELOCs are a treadmill, yes, but convert your mortgage balance into an amortizing loan of 30 years. You're going to pay principal and interest, because most people do not pay attention to their HELOCs, and they're going to pay interest until they die. I've been caught there before, and I can tell you it will happen. If you're the person that is in that retirement stage, or you're trying to help a family member through this, you should definitely consider the possibility of helping them reverse stages on those draws. Like, if you're doing a reverse mortgage, you don't take it all at once. You take a chunk and a chunk and a chunk and a chunk, and then invest it, or make sure you're spending it wisely. This ensures that, like, as time goes on, the equity grows in the property, and they're making sure that they're just taking out what they need. And this is a big thing. Like, when we talk about Canadians who are planning to retire in the future and using their homes, people don't plan for downsides or downside risks. I mean, from 2008 to 2015, we didn't barely see the real estate market go up in value. And in some places it went down. It wasn't until like 2015, 2016 that we started to see that lifeline come back. And then, of course, there was the upwards trajectory with the crazy hockey stick of 2021, and then 2022, and then 2022 and a half happened. And then we saw the opposite occur. So if you're using your real estate as part of your plan, sure. But don't think of it as the baseline of something that will stay the same forever. You can't predict the timing of that. I'll give you a quick example of a couple of clients that we worked with in their personal scenarios. A couple that we're working with that were 60 and 62 years old, living in a detached home, Surrey, BC, wanted to stay there. Their mortgage renewal is coming up, and their payments were going to go up basically 18%. If you want to know what that is, it's $18 on every $100 that they're borrowing, and that's pretty significant. 1,000, another 180, and on and on and on. So not a small chunk of cash. So they needed about $25,000 to be able to do the renovations on their home to make it continuously livable. And instead of doing like a full reverse mortgage, what we did in their case is we did a modest refinance with a basically kind of like a HELOC type of product on it. We stayed way under the 60% loan to value mark. So in this case, we stayed about 40% loan to value, which is their maximum, which gave them the money that they utilized, the money that they needed to be able to have the mortgage plus the equity for the renovation, while making sure that we weren't just taking on a significant amount of money for no reason. Cut it, kill it, case study dead. That sucked. Just cut this whole case study thing. From an anecdotal perspective, I've worked with now probably about 6 or 7 borrowers this year alone that we've re-strategized and recommended them to honestly not take out as much capital as they were originally going to take out, because it would put them in a position where they were taking it all out and they had no backup plan in place. So instead, we kind of built out a plan where they took out a certain amount of equity. We set up a home equity line of credit in case of an emergency situation, recommended essentially that if they take that money out and it's going to be out for a long time, that they convert that into an amortizing portion, which is a mortgage payment, so that it's paid down, every so often as they're making their payments. Now, I mean, again, we bang the drum of what to do or what not to do, but I do want to touch on some like myths of real estate, because this is where it kind of goes back to like the fact of real estate always goes up in value. That is so not true. And I don't know where people get this in their minds that it's going to forever and perpetually go up. Yes, long trends are correct. Over time, real estate typically goes up. But what I actually recommend is in most cities that I'm looking at, I look historically the last 10 years, the last 20 years, I pull up the top couple years and I pull up the top bottom couple years. And like, this is probably your trend line. It's a 3, 4, 5, 6% appreciation rate. Like that is what we're looking at for our property viewers. And the upside of a 15% increase is a crazy bonus. It's not a baseline. You need to be conscious if you're using any real estate purely from an appreciation perspective that it is speculative and it is not a guarantee in any market. The second thing I always be very cautious with people as it relates to real estate as part of their portfolio is that a HELOC being used like income. A HELOC is an awesome tool. Like I'm going to do another video on it soon where we're going to talk about how to use a HELOC and what to use it for, but it is not an income source and it should not be used that way. And it's crazy how many people I come across who did this, and they're not bad people. They just were never really taught what to do and how to pay it off. And you just forget about it. So it ends up being like this permanent anchor dragging you down. The other thing that I've heard a lot of lately is this concept of I'll just sell the property later. And the reality is selling under pressure in a soft market is when people lose their retirement plan. I don't think most people are consciously considering not only their financial future, but the implications of using your real estate on your primary residence specifically as your retirement strategy. Your house and hope are not a plan. Canadians, you got to wake the F up. And the reality of our government intervention says that they're probably going to continue to add new rules and new legality, and maybe they're even going to tax us like capital gains. You need to be conscious of having a more clear plan, whether that's looking into this strategically from a tax perspective and saying, okay, I've got my home, I can use it to help me, whether it be a Smith maneuver or reduce my income taxes like cash damming, or maybe neither of those. Maybe that's not it. Maybe it's just like strategically speaking, restructuring your monthly payments so that you can invest into something else with a higher ROI, right? No matter what, you need to start now. I want to impress this upon you. You don't have forever to choose when you're going to invest. You don't have forever to make a plan. You need to make a decision today to put a clear plan in place. And if your retirement only works when your house price goes up in value, you do not have a retirement plan. You have pure exposure to one place. Listen, I am pro real estate, but I'm not freaking blind. For Canadians, the home has become the retirement plan and strategy. And that's fine as long as you can treat it with discipline, you have the guardrails, and you have timing. And most people do not have that. But if you do it right, I mean, your home can fund retirement. If you do it sloppy, you're screwed. Either way, I don't recommend it be the only source of income for people in retirement. But if you're too far along, then it is what it is. I put together, if this impacts you, if your parents are in retirement strategy, if you are thinking about your retirement, you're like, holy crap, what do I do? I put together a pretty straightforward equity lifeline checklist, which is basically 6 steps. Decide if you should sell, if you should buy, or if you should hold in 25 and 26. And if you send me your questions, you can DM me on Instagram at themortgagepug, at Flow Mortgage Co. I'll break this down, real life scenarios and real examples for future episodes as to what a 35-year-old person who is trying to get in the market, a 45-year-old person with kids who's trying to just figure out how to get rid of debt, and a 55 to 60-year-old person who is thinking about retirement should do going forward. Just send me a DM or send a note below and just put equity, and we'll send you the checklist to your email address so you can get a copy of this to set yourself for future success. Thank you for listening. If you found this podcast useful, if you found this information helpful, do me a favor. Leave me a thumbs up if you're on YouTube. If you're on the podcast and you can't see me, thank you for watching. Go ahead and leave me a rating on iTunes and Spotify, and share this with somebody else that you think this would be useful. My goal is to educate Canadians to be more wealthy and better off. And if this was more impactful for your life or impactful in any way, let me know, please, so I can keep doing what I'm doing well. Peace out. See you on the next one.